Vera is the head of research and strategy at Bulltick Capital Markets and joins us now. Kathryn, thanks for being with us as always. So we're sitting here looking at these all-time highs. You know, some people saying it's hard to get rich when you buy at the top. But how have you been thinking about this market and where we go from here?
Yeah, John, you're right. I mean, that makes sense, right? It's hard to get rich when you've already seen a 45% rally, which is unprecedented in its velocity and its magnitude after such a steep decline that lasted so short a period of time. So the question that I'm getting is exactly that. What do I do now when we're at record highs in the U.S. equity markets? Where is the value? So what I'm telling clients is, look, you can look for sectors instead of the broad index. I think it's not a mystery to any that technology has been the main driver of the ascent in the equity market. So look at the sectors that have pulled up the rear, specifically banks or energy, for example, or communications. These are sectors that have pulled up the rear. But I think what we also need to look for is value in alternative locations. So Europe has also pulled up the rear in terms of this rise in equity markets, as well as emerging markets, and those specific regions are catching a bit of late.
All right, and you know, that kind of echoes what you told us late last month when you were raising questions around the pretty stretched valuations for technology stocks. I was saying before you joined us, Kathryn, it was pretty amazing that yesterday, you know, the S&P is up about 0.2%, and I think it was like a third at best of the index was actually higher. I mean, there have been so few days in history where you have a dynamic like that. I think what's tough for a lot of investors is, I go back to this theme around value, like how you find value, how you look at something that did not participate in the rally and you say, okay, actually the business fundamentals look pretty good. I'm going to make this bet, and I'm not going to worry about if people are piling into tech for the next couple of months. This is a good investment. What are some of the tools and tricks that you use on that front?
John, that's such a critical question. And I'll tell you, as a market economist, the Fed has made it very difficult for me and a lot of my peers to really fundamentally value sectors or even economies at large because of the magnitude, the unprecedented magnitude of the liquidity injection. So it's really hard to underestimate the magnitude of the stimuli, both fiscal and monetary. And that's really what's driven us this far, this fast. It's not that the economy is back to where it was pre-COVID crisis. No, it's the fact that the U.S. fiscal deficit has been quadrupled, not even including the next round of stimulus that everyone, and I as well, expect to occur. It's that you get fiscal and monetary at the same time. The Fed has taken its balance sheet from $4.5 trillion to almost $8 trillion now, and it's likely to continue to purchase assets through year end to get to maybe $12 trillion. The Fed is buying not only U.S. treasuries and mortgage-backed securities, but it's buying investment-grade bonds and now high-yield bonds. It's buying ETFs. So this is what we have to contend with. So while one might say, as I do, the markets really don't jibe with the fundamentals that the economy is experiencing, one has to try to, make money, and that's our game. So I think we need to think of what the Fed is doing, what it's going to continue to do, and realize that this rebound in consumption, a lot of it is due to government benefits and this surge in pent-up demand that we saw from when the economy was effectively shut down during the peak of the COVID crisis.
Helpful context there. It has been a wild political week in Canada that it's kind of unusual for us to not be focusing on a very big political story unfolding in the United States. But obviously the Democrats rallying around their choice for President Joe Biden this week, which is a reminder we got an election around the corner. As a market watcher, how are you thinking about the election? What would be your advice to investors on how to think about it and maybe position around the U.S. election?
Well, it's interesting because we've seen a lot of options activity, more than usual, in this election. So that's a bit of color, be it what it is, be it what it may. But I think that we need to consider what has been the driver of the markets and think about how next step policy making might impact, for example, technology. If in fact we do get words that turn into action from a Democratic, perhaps White House, perhaps Congress, we should expect higher taxes, not just on the individual, but we should expect higher taxes on corporations, especially the big guys. We should expect more antitrust, heavier regulations on these large corporations, which, as I say, have effectively boosted the S&P. So I think we need to be wary about tech at both current valuations and future growth opportunities in a new political environment. I don't think that said that you're going to see a big drop in the S&P. Granted, the U.S. equities, global equities, have not internalized the impact of a reversion of the corporate tax reform. They haven't perhaps internalized the fact that there will be higher regulations, higher taxes, more big government, et cetera. But that said, I doubt the market drops. And if it drops, I will be recommending a buy to my clients because, as I mentioned in the beginning of our conversation, John, the Fed's backstop is so potent because we're dealing with an unelected entity that is completely insensitive to prices. So where the Fed is willing to react, at what drop it's uncomfortable with, no one knows. But what we do know is the Fed is ready and willing to intervene in the markets as it has up to this point.
Helpful context. We'll be watching closely. Kathryn, thanks so much.
Thank you, John.
Kathryn Rooney Vera joining us of Bull Tick Capital Markets with her market perspective.